David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello, everyone. This is our 9th podcast of this series. We took a few weeks off, but we're back to doing the podcasts, and today we will focus on the reopening of global economies as well as trends that we're observing with COVID-19, in particular regarding the potential for a second wave, how that might impact the economy, and how markets are reacting given employment trends and other metrics. Please feel free to share the links to these podcasts with anyone that you feel may also benefit from having the information that we're disseminating through this channel. So as usual, let's get started with a quick overview of the market. As we're recording this on Thursday, the 16th of July, looking back to the market close on Wednesday, the Dow Jones Industrial Average closed with a value of 26,870 points. And as we've mentioned earlier, the intraday low for the Dow Jones Industrial Average occurred on the 23rd of March with a value of 18,213 points. Only time will tell if this proves to be the low for the event. Earlier this year, the high water mark was established on the 10th of February with a value of 29,379 points. So from the high water mark to the low water mark, the Dow Jones Industrial Average lost 11,338 points, or 38%. Now, since that time, as of the 15th of July, the market is higher by 47.53% from the March intraday low. So year to date, as of the 15th of July, the market is still down 6.92% for the year. Now you're looking at a current graphic of the last several months depicting the Dow Jones Industrial Average. And as I've said before, I'm a visual person, and I like this graph because it puts the last several months into context. While this helps to visualize the degree by which we've embarked on a potential recovery, there is still a significant amount of angst that all of us have as investors. We all want this to be over so that we can return to normalcy, return to life, and get back to living our lives. That said, though, from an investment standpoint, patience remains the key, and you can expect that any recovery will include periods of second-guessing and retracing. This characteristic is normal of any market recovering from an acute shock. Okay, so let's move to our economic overview. From previous podcasts, we've discussed values of energy futures and the TED spread and other metrics for clues about what the energy complex and the bond market, for example, might be suggesting about the potential for more robust economic activity in the future. These indicators continue to suggest that we have a much greater chance of experiencing a robust and expanding economy as opposed to the alternative. Oil futures, for example, continue to move higher, with prices reaching into the mid-40s as of the time of this recording into 2011. But let's take a closer look at what I think are more key economic data points that we're observing right now, and we can start with employment. The most recent Labor Department reports continue to demonstrate strength month over month, most recently with 4.8 million jobs added in the month of June, and the unemployment rate dropping to 11.1%. Now, I never thought I'd be happy with an unemployment rate of 11.1%. But it is certainly lower than what the majority of the economists projected just a few months ago. You were looking at the most recent graphic from the St. Louis Federal Reserve Bank of the 4-week moving jobless claims average, and that is 82% lower today than it was at its peak on the 8th of May. Well, look, there can only be one explanation for such a dramatic decline in a metric that by design is smoothed for short-term volatility. Workers must be back at work and at an increasingly faster rate. All right, well, now you're looking at a screenshot of one of, to me, the most impressive aspects of the most recent report from the Department of Labor, and that was that participation rate increased to 61.5%. Again, this is significantly higher than readings from just 3 months ago, and it supports the forward look of the 4-week moving jobless claims average, and it validates the last 2 reports of 2.71 million jobs created in May and 4.8 million jobs created in June. Both of those were records, I might add. So what about forward-looking market indicators? We've talked in previous podcasts about how the market itself is a discounting mechanism, and as such, it is viewed as a forward-looking indicator with regard to economic activity. So I mentioned earlier, we are 47.53% higher from the low water mark set on the 23rd of March. I see this as the market looking ahead and pricing into itself the possibility of increasingly robust economic conditions over the coming quarters. But the bond market can also be a good forward-looking indicator, and the TED spread serves as a proxy for bond market sentiment. And we've discussed this in previous podcasts as well. You're looking again at a graphic of the most recent depiction of the TED spread from the St. Louis Federal Reserve Bank. As of Wednesday, the 1st of July, the TED spread stood at 16 basis points. This is almost in line with spreads that we observed in February. At that time, we had 18 economic metrics that were either at their highest recorded levels or had posted results that we hadn't seen in decades, in some cases. I believe that this is an encouraging sign that both the bond market, as a function of the TED spread, and the equity market are both seemingly indicating the belief that we will have increasingly robust economic conditions ahead. In past podcasts, I've addressed the question about whether this downturn could become another financial crisis like the one that we experienced in 2008. I believe if the bond market sensed that such was likely, then the TED spread would be reflective of that right now. It wouldn't be at 16 basis points. So now you're looking again at the same TED spread graphic from the St. Louis Fed, expanded to include the Great Recession. If you'll look at the 458 basis point spread that we observed on the 10th of October in 2008 and compare it to what we've recently seen on the right side of the graphic, you can clearly see what the financial-induced Great Recession looked like, and that it does not compare at all to what we're observing today. So as far as opening the economy is concerned, we have in the U.S. now had almost 2 months to gauge the initial effects of reopening the economy. There does remain a concern about a resurgence of COVID-19 possibly disrupting this economic momentum, and clearly this concern is legitimate. However, I'm driven by what I can quantify. So let's examine metrics from around the world to see what we might be able to glean about this and address the concern. In previous podcasts, I've drawn reference to the Purchasing Managers Index, or PMI, and readings from countries around the world. This data is gathered from outside looking in, by looking at quantifiable output, industrial output of an economy. So this means that no government can manipulate or inflate the results. You are either making widgets or you're not. Just last week, the data set from June was published for the Eurozone, and I've included a subset of that in the graphic that you're seeing on the screen right now. So at the top, I've included China because they were the epicenter country. At the bottom, I've included the United States. I've thrown Sweden in there because their economy never closed down, as did many other economies. And it's interesting to see where their results are now in comparison to other countries. Any PMI reading below 50 is considered to be in contraction territory, while anything above 50 indicates expansion. So being the epicenter country, China saw their PMI reading fall to depression levels in February. Since then, 3 of their last 4 PMI readings have reached into expansion territory. Now, I can't say that I have much faith in what China tells us about their COVID-19 situation, but PMI readings, again, are a look into Chinese industrial output. You're either making things or you're not, and you can't manipulate that observation. Clearly, China has 4 consecutive months of a return to industrial output normalcy. And no one can argue with that. One can assume that the only way such could be possible is if workers were not only in the factories, but also healthy. The Eurozone was about 45 days behind China in terms of its COVID-19 impact, and you can see that on the graphic. China hit their manufacturing low in February, with countries like Germany, Italy, Spain, France, the United Kingdom, Sweden, all reaching theirs between the months of March and April. Well, in Germany, we've seen PMI readings increase from a low of 34.5 to 45.2. Spain has risen from 31 to 49, and that's a significant increase. France climbing from 32 to 52.3, back into expansion territory. Italy was arguably the hardest hit nation in the Eurozone, and we've seen their readings improve from 31 to 47.5. The low points for the United States occurred about 45 days later than they did in the Eurozone. And as of last week, our PMI manufacturing index had risen to 52.6 from a low of 41.8, and our services PMI rose to 57.8. Both halves of the economy are back into expansion territory. And we've talked about this in previous podcasts, that what we saw developing across other economies of the world would give us some good insight into what we could expect to see here over the coming 30 to 60 days. All right, well, we are watching that unfold right now. So now the next question is, while we can quantify the return to industrial output across these economies, do we also see any evidence of a new second wave of COVID-19? Well, you're looking at the most recent graphic for Germany. Remember, as you're looking at this graph, that across the 33 economies of the Eurozone, most of them opened around the middle of May. So we have 60 days now to observe recovery in terms of their PMI index, and you can clearly see on this graphic that we don't see any new second wave of new cases in Germany. We don't see a new second wave of cases in Italy. Neither do we see a second wave of new cases in Spain. We see no new wave of cases in the United Kingdom. And frankly, I can show you 33 of these mountain charts that show the same pattern. So now you're looking at the new cases, new positive results in the United States. Okay, frankly, the United States had been following the same pattern of declination exhibited by the Eurozone countries right up until the last few weeks, where we have seen social unrest and thousands of people in major urban areas not wearing masks and congregating. In my opinion, the danger of a subsequent shutdown of the U.S. economy will likely have more to do with a spike in rates of death than it will with a spike in rates of positive results. So now you're looking at the most recent graph, again from Worldometers, that shows clearly that the rates of death continue to decline in spite of there being a new spike in new cases, which the data is increasingly showing us that it has more to do with unrelated economic issues. In other words, this spike in cases, in my opinion, does not seem to be correlated with the reopening of the economy. This graphic clearly shows that rates of COVID-19 deaths continue to decline, even as new results spike. And honestly, there's a lot of talk now about how COVID-19 fails to meet the criteria for being called an epidemic. Now you're looking at a similar graph that shows the rates of death, weekly percentage rates of death related to COVID-19, and the orange line is what the CDC defines as being the epidemic threshold at 7.2%. We haven't been there since early June, and this graphic is about 2 weeks old. Today, according to the CDC, that rate now stands at 1.4%. So we are headed in the right direction in terms of the most important consideration, the fatality of the disease. Indeed, this curve for the United States looks almost exactly as promising as that of the other 33 economies in the Eurozone. The United States has also been testing more people than ever before, which will naturally lead to an increase in the raw number of cases present in the country. In their attempt to sensationalize, the media continues to simply add today's result to yesterday's total, and the sad truth is that number will only rise. It never declines. You must look more deeply if you are trying to discern the potential impact of COVID-19 on the economy and thus your investment decisions. The media is giving you no actionable information upon which to rely in that regard. Lastly, on the economy, I'm continuing to monitor a range of high-frequency, forward-looking economic metrics. These are just a few, but these are the ones that are showing a tremendously positive result right now, and they include TSA checkpoint headcount up 47.5% month over month, hotel revenue per available room up 38.2% month over month, hotel daily average rate up 19.2% month over month. Hotel occupancy up 6.3% month over month. We've talked about initial claims. They're down 15.5% month over month. Continuing jobless claims are down 14.5% month over month. And this one is a forward-looking indicator to me. Steel production is up 6.5% month over month. Well, this corroborates what we've seen in the macro industrial economic metrics, and it bodes well for future auto production, future heavy machinery and equipment production, aircraft production, sources of demand for steel. We're seeing steel production up 6.5% in just the last 30 days. I'm also looking for signs that the payroll protection plan had an impact on the economy, both in terms of continuing salaries and thus enabling employers to bring employees back to work, but also on the behavior and attitude of consumers. One significant indicator I am watching for this impact is retail sales. Now you're looking at a graphic of a screenshot that I took a few weeks ago that reflect May retail sales. This was a huge surprise to the upside, up 17.5% in May, and yesterday we learned that retail sales were up again in the month of June by 7.5%. This is a great sentiment proxy for the consumer. And remember, personal consumption is about 70% of gross domestic product. So in conclusion, 4 months ago, not one expert in the mainstream media suggested that we may be on the precipice of the strongest quarter for the market in 33 years. That's exactly what we saw, though. If you were a participant on my conference calls back in March, and if you've been dialing into these podcast updates, you have heard me talk about the behavior of shocked markets and how we needed to be mindful of historical behavior patterns at times such as these. You've heard me talk about objective-driven investment strategies, and that over time, those who have had the intestinal fortitude to remain focused on long-term objectives have been rewarded. Every recovery from a crisis-induced market low is always characterized by periods of euphoria and second-guessing. The markets continue to discount the potential for a second wave of COVID-19 and the impact it might have on the economy. And as we get further into the year, the markets will begin to discount the impact of the November elections. As investors, you must remain focused on where we are going and the objectives that lie ahead of you and the investment strategies that were crafted as a function of those objectives so that you can rise above the noise and make investment decisions that will be of benefit to you down the road. So in conclusion, we are continuing in our strategy to reach as many of you as proactively as we can, and this includes having Zoom video meetings. On a very select and rare occasion, we are having the in-person meetings again. We are following mask protocol for that. In the meantime, we will continue to reach out through Zoom, through conference calls, through individual phone calls. We will continue to do these podcasts as well as posting on our business social media. Please follow us and receive those emails, because this is an effort to communicate with as many of you as possible with actionable information that you need to have. We are trying to feverishly stay in contact with all of you and lead in this crisis from the front in a proactive way. Please never hesitate to reach out to us with your questions or needs of clarity. I said this back in February, folks. We're going to get through this together. And 4.5, almost 5 months into this, I can say that that we're making progress and doing a good job in that. So we will continue. We're not out of the woods yet. We're a lot further out of them than we were a few months ago, but we've got a lot further to go. So thank you for your attention to this podcast, and we will talk again soon.
David Guttery and Brandon Guttery offer products and services using the following business names: Ameritas Investment Company, LLC, AIC, member FINRA, SIPC for securities and investments. Ameritas Advisory Services, AAS, for investment advisory services. AIC and AAS are not affiliated with Keystone Financial Group. Products and services are limited to residents of states where the representatives are registered. This is not an offer of securities in any jurisdiction, nor is it specifically directed to a resident of any jurisdiction. As with any security, request a prospectus from your representative. Read it carefully before you invest or send money. A representative will contact you to provide requested information. Representatives of AIC and AAS do not provide tax or legal advice. Please consult your tax advisor or attorney regarding your specific situation.